Today, we are going to figure out how to stop your Airbnb from bleeding money.
Now, things don't always go according to plan, but there are tons of ways to optimize pricing, asset management, and amenities on your property.
So maybe you're spending too much money on operations, or maybe you need to find an exit strategy. We'll break this down and more next. I'm Ashley Kerr, and this is the Real Estate Rookie Podcast.
And I'm Tony J. Robinson, and welcome to the podcast where every week, 3 times a week, we bring you the inspiration, motivation, and stories you need to hear to kickstart your investing journey.
Okay, so Tony, what's our first question today?
So the first question says, I'm currently house hacking a property that has an ADU that also generates income. I bought this property intending to leave and then rent the house out that I currently live in, which is a 2-bedroom, 1-bath. I have a very good interest rate that I locked in during 2022 that I don't want to lose, or maybe have my mortgage called due to not living here. I live here for very cheap because of the income generated from the ADU. I'm getting ready to make my next move in 2025, and I'm contemplating on staying here and buying a multifamily property as an investment out of state, which would be a lot less capital and have a lot more landlord-friendly laws, or buy another multifamily property as a primary residence locally and house hack that property. I'm single and I live alone. What are the pros and cons of each situation?
Tony, the first thing that comes to mind is how they mention, I don't want to lose my good interest rate or have my mortgage called due from leaving here. So the first thing I want to bring up is that they've owned the property, it looks like, since 2022. So depending what kind of financing, a lot of times you only have to live there for a year. And then after that, the bank can't call the mortgage on you. So you would be able to turn that into a rental, not just the ADU. So that was something I wanted to address too, that it doesn't mean that you can't keep that mortgage on there and not live there anymore. Usually there's some kind of time frame that you have to live in the property and be your primary. Then you can leave and keep the same financing on the property.
Great call out, Ash. And you kind of read my mind on that piece. And I think before we really jump in, just to set the table for some of our more rookies who maybe aren't familiar with the term house hacking, but a house hack is basically you buy a property, much like the person who asked this question, and you live in one portion of that property and you rent out another portion of the property. It could be a 2-bedroom, 1-bath, and then an ADU in the back where you rent out the ADU. It could be buying a duplex or a triplex or a fourplex. It could be buying a single family home with a basement. It could be just buying a big house and renting out the other bedrooms that you aren't using. So there are different ways to house hack, but I just want to make sure that we set the table for all of our true rookies that are listening so you understand what a house hack is. So great first point, Ashley. Hey, you could just potentially move out anyway and not have your loan called. So you still get to keep the interest rate and you get the ability to generate some revenue there and then potentially just recycle the primary residence and low down payment, maybe lower interest rate and do this all over again. Are there any benefits that you see, Ashley, to potentially just buying the next deal as a true investment property?
I guess the only thing I think of is where they're living now. So it says out of state. So would this be a more landlord friendly area where it will be easier to manage the tenants? So I'd look at that as the laws, and actually it does say in there landlord friendly laws. So that's one huge benefit there. But I think really the biggest thing that it comes down to is your personal preference. Do you want to keep living where you're living, or do you want to get another primary residence? I think that's a really big decision in this factor. And then the second thing to kind of look at as to when you analyze both situations, at what point do you end up with more money? So for example, if you decide you're going to stay in your current property and you're going to buy an out-of-state investment, what in 5 years from now, what will be your equity in the property you're living in as your primary residence? What will be the equity that you have in the out-of-state investment? And what will any cash flow be over those 5 years that's generated from these investments? Okay. Then I would look at it as if you keep your current property and turn it into a rental. And then if you go and purchase another primary residence, what does, the equity look like in those properties? Because the down payment would be very different if you're investing out of state and you're going to get traditional financing, you're most likely going to have to put 20 to 25% down. But if you're going to buy a second primary residence, then you could possibly put as little as 3.5% down or 5% down on the property. So a great starting point is the capital that you have available. Are you going to be able to have enough in reserves, 3 to 6 months expenses at least to save for each of the properties that you're purchasing? Have the down payment, any startup costs you need to lease the unit, things like that, hiring property management if it's going to be out of state and you're going to use property management. So I would start with running the numbers on both situations, but I feel like personal preference does come into play here. Do you want to move into another primary residence and keep this property as a rental? I would suggest not selling the property. I would say keep it as a rental and then move into another property, not selling it and then moving into another primary. Because as the primary residence too, keeping it, whatever one you end up being in, there's so many benefits to having the primary residence, like the homeowner exemption for property taxes, better financing terms. So you have to also compare that. If you turn your current residence into a rental, you're no longer getting the property tax benefits. There's other things. Your insurance is going to change because you're going to have to change your policy. So looking at those different aspects too are important.
Yeah, you highlighted so many different important things to consider, Ashley. And I think overall, I would agree with you as well. Like for me, a lot of times it just comes down to what do the numbers say? And over the long run, which will actually present itself as a better investment opportunity? Is it putting down 20, 25% on a pure investment property, or is it continuing to house hack? But, and again, this is without having all the context of your situation, but you say that you're living pretty cheaply right now. So you've had a somewhat successful house hack already. You're single and you live alone, which is the ideal situation to continue to house hack. So at surface level with what I'm hearing, I feel like my preference would be, or my suggestion would be, to replicate what you've already done successfully and do it again, and then do it again, and then do it again, and then do it again. And if you do that every 12 to 36 months, where you're just recycling your capital into another house hack, and maybe the next one's a duplex, then maybe you buy a threeplex and a fourplex, and you look up 5-7 years from now you've got a really solid portfolio where your cash out of pocket was relatively low because they were all primary residences, and you can have a decent amount of cash flow coming off every single month. So again, surface level, that's what I'm hearing as maybe the best path forward.
Yeah. And like one thing with comparing the markets of the market you're already in, if you bought a new primary, and the other market is, the out of state market cheaper, and that's why you're thinking of going there to purchase a property. Well, you could get a very low down payment, but you may have to put a very high down payment. And what is the actual difference between those down payments with the percentages that you have to pay for each? Because the investment property is going to be a lot higher down payment, that it might not actually be that big of a difference when you compare it to putting 3.5 to 5% down for your primary residence, even though it's a more expensive market too. And then the last thing I'll say on this too is how much time do you have to build out another team? So you're going to have to find if you're not going to self-manage, you have to find a property manager. You have to find an agent to help you find the deal. You have to, if you're going to self-manage, you need a boots on the ground, you need a handyman, or you need vendors. So to, weigh that as an option too. And you can always go to biggerpockets.com/teams and, put in your market and who you need, a lender, an agent, property manager, and you can find them all there. It's definitely gotten easier. So really think about that as if you want to put the time and the energy into building out a new team to support that property too.
Yeah. Just last thing I'll add, I really do believe that house hacking is one of the best ways, both from a financial perspective and just from an ease perspective, to get into real estate investing, because you're killing two birds with one stone. You're getting your own primary residence that you can live in, everyone's going to need a place to stay, but then you're also giving yourself the ability to build equity, build cash flow, and do it at a really, really reasonable cost. So I would have done it just where I live in California. There's not a lot of small multifamily. It's just not what they build out here. But it sounds like he or she's in a great position to do that.
Tony, you're about to add a new roommate to your house hack. You are doing it.
And she will be paying rent on day one, so we're gonna find a way. Our oldest, he just turned 17, and I told him, I was like, dude, you got 365 days until you got to start paying rent. So we'll that's the plan. We're having more kids so that when they turn 18, they can start turning into tenants for us.
Okay, so before we take our next break, I got to ask you guys a question. If you are a rookie investor and craving some accountability, then you guys need to check out the BiggerPockets Momentum Virtual Summit. You can go to biggerpockets.com/summit25. You are going to get 8 virtual sessions to attend that cover different real estate investing topics that are actually really relevant to investing in today's market. The most important part, though, is that you will get to be involved in an accountability group with like-minded individuals. So go to biggerpockets.com/summit25. Stay tuned after this short break because we are going to analyze a market for you. Okay, welcome back. Tony, what's our next question today?
All right, second question says, I'm trying to buy a duplex as a first-time investor in Columbus, Ohio. Any real estate agents that you would recommend, or just any suggestions and advice for a real estate rookie? Boy, do we have a lot for you. I think the first resource is the BiggerPockets Agent Finder. So if you guys head over to biggerpockets.com/agent finder, you'll get connected with a lot of BP-approved realtors who work with investors. They're the quote unquote investor friendly agents. And honestly, a lot of the folks you get connected with are investors themselves, right? So they know the market really, really well. So I think that should be your absolute first stop, is going over to the Agent Finder. But Ashley, what do you think? Any other advice for someone going into a new market? And we don't know where they're at, like where they're based out of. I don't know if Columbus is home for them or if this is long distance. I'm assuming it's long distance. Otherwise, I wouldn't be maybe asking for some of these resources. So if you're going long distance real estate investing, what's some advice you could have for a rookie?
Well, first I got to say, Tony, I'm really disappointed you didn't throw out a Tommy Boy quote for all our OG listeners that used to love the Niners and knows that Tony had never seen Tommy Boy. You're probably thinking the same thing when you hear Columbus, not Columbus, Ohio.
I actually don't remember. I don't remember that line from the movie. It's been like 5 years, so I guess I gotta go back and freshen myself up on some Tommy Boy.
It's been a long time since we talked about Tommy Boy on the podcast too, so I need to start bringing it up more to refresh your memory. So Tony and I did a ton of research on Columbus, Ohio for you guys, and some of this research we actually grabbed from biggerpockets.com/resources. So Austin, who we've had on the podcast before, he actually put together top markets for 2025. So you can go there and you can see his whole spreadsheet. You can search your markets that you're looking to invest in. But we pulled the information for Columbus, Ohio. So it has a median price of $344,000. And I think the median home price like across the country is like over $400,000. So that's good that it's cheaper than most of the US. The rent to price ratio is 0.54%. And there's always the 1% rule, which is very hard to find. You can find it in some states where, the rent is 1% of the purchase price, but usually there's some other caveats. So for example, in my market, high property taxes. So, that kind of wipes out what your expected cash flow is if you're going for the 1% rule. Tony, what's some other information that we pulled off that chart there?
Median income for this area is just under $60,000 per year. 5-year population growth just under 5%. Vacancy rates about 6.5%, and unemployment rate at just over 3%. So some strong kind of data points for the city. And then Ashley also did some additional research above and beyond what Austin gave us, and found that Amazon is spending $10 billion. Billion with a B, $10 billion to build a data center and a 32-story mixed-use skyscraper that should be done at some point next year. So talk about big employers coming into a space. And, it's not like it's an Amazon warehouse, right? We're talking about a data center where typically you're getting more white-collar professionals that, salaries going to be a little bit higher. So some good signs for Columbus. Ash, where else did you go to maybe get some more cool insights about Columbus?
Yeah, I actually went into the BiggerPockets forums and I just searched Columbus, Ohio. And I, kind of filtered it to the most relevant, the most recent post. And, Intel is also doing a big chip manufacturing plant in Columbus. I did notice someone had posted about stores having headquarters in Columbus, and that was Bath and Body Works, Victoria's Secret, and Big Lots. I would take this with a grain of salt because I know all the Big Lots stores in New York, at least, are all closing. So maybe those aren't the best companies to have headquarters that you want to search for. But also, Ohio State is opening a brand new hospital that's going to open in 2026. So that could be something big right there too. And somebody had posted that the actual neighborhood, because I love it when you go into a city and you niche down to a neighborhood instead of looking at the city as a whole, because each neighborhood can change so much. Like you can see growth in the city dropping, but you could see like in all the suburbs around it, flourishing and growth. So always niche down to your neighborhoods. And New Albany is actually the neighborhood where all the tech companies are going. Then, of course, you have Ohio State University there. You have college students. You have parents coming to visit the college students. And then also Columbus, in a sense, is central to major cities as it's in driving distance to, Pittsburgh, to New York City, to Chicago. So kind of central to that. And then it's also landlord-friendly laws, too, which we all love. Then kind of the last data piece Tony and I pulled from brightinvestor.com. There's other ones called Neighborhood Scout that you can find all this stuff on. Tony, what were some of the things that we saw in there?
Yeah, mostly that, this might be true for a lot of the major kind of metros, is that some of the submarkets or surrounding areas around Columbus have better appreciation, growth, and then you see shorter days on market than what you see like in the city center. So overall, feels like Columbus has a lot of things going for it right now. And honestly, I've just heard Columbus is like a place that a lot of other investors have been talking about in the kind of BiggerPockets ecosystem or kind of neighborhood just in general. So I'm not super surprised to see someone else looking into it. But I think even with all of that, and this is for all of the rookies that are listening, guys, there are, again, 20,000 plus cities in the United States. So the chances that there's only one city that makes sense for you to invest into, it's just not going to happen. There are hundreds, maybe thousands of cities that you could potentially invest into that still make sense. So as you're going through your market selection journey, the goal isn't to find the Goldilocks city that checks every single box in every right way. The goal is to find the city that satisfies your investment requirements. And if Columbus has done that for you, then you have no reason not to move forward, to start analyzing deals, start submitting offers. So I just want to really, really frame that up for all the people that are listening. It could be Columbus, it could be Buffalo, it could be Los Angeles, it could be whatever city. As long as it checks the boxes, that's really all you need to move forward with something.
And we do have a market analysis, a spreadsheet that you can go through. And this has like every metric listed that you should be looking at when analyzing a market. You can find that at BiggerPockets.com/rookie resource. So Tony, I have one follow-up question for you based on this before we go to our second ad break. But have you heard of Columbus, Ohio for a short-term rental market at all? Is there any buzz around that at all?
I'm trying to think. I can think of maybe a couple of people who have purchased in the Columbus area, but a lot of it were folks who were just like in that area already that I know personally. But I really do believe that the shift in the short-term rental industry, and I've said this on other episodes, is that you've got to start identifying some of these markets that aren't like these big, well-known vacation destinations, because those are the markets where we've seen a tremendous increase in purchase price over the last several years. Some of these markets have seen revenues decline during that same period, but it's these markets that are maybe more mid-size, right, where there's a little bit more opportunity. So I haven't dug into the data for Columbus specifically, but just hearing what I'm hearing feels like there might be some opportunity there. And I guess one last question for you, Ashley, because we talked a lot about like Columbus as a city, but just in general, if someone's looking to invest long distance, some things that I think they should be focusing on to begin with. If you've never gone to that city, I think the first step of finding a good agent, definitely the most important step, right? So BiggerPockets.com/agent finder. I think trying to connect with a good lender who really understands that local market as well, super big. Again, my first investment I ever purchased, it was several thousand miles away in Louisiana. And part of the reason why I was confident to go into that market was because I found a really good local lending partner to work with. And they kind of unlocked other doors and other opportunities for me. So your lender, your agent, two people to really focus on building relationships with as you go into that market. Ashley, anything else that you think a new rookie might consider as they're doing long distance for the first time?
Well, one thing is Austin's spreadsheet that we mentioned that you can find at biggerpockets.com/resources. If you don't understand, like if a metric is good or bad when you're, analyzing an out-of-state investment, then use this spreadsheet as a resource. So you can go through and look at what the unemployment rate is for every single property. And you can gauge like, okay, 2%, that's a great unemployment rate. 8%, that is not. Like maybe I don't want to invest in that area. But you can use that spreadsheet to kind of gauge what's the average across the country. So that's another unique reason to take a look at that spreadsheet if you do need help analyzing those out-of-state markets. Okay, we have to take one more final ad break, but we'll be right back with more after this to discuss maximizing revenue in your short-term rental. All right, let's jump back in. Tony, what is our last question today?
All right. So the last question says, I'm looking for some guidance on improving the performance of our short-term rental, and I'd really appreciate your insights. Here's a quick breakdown of our financials. So operating expenses, excluding our mortgage, was $33,000. And all these numbers are for 2024, so for the entire year. So $33,000 in operational expenses. Annual mortgage payments were at $58,000. So their total need to break even is about $91,000. And their income earned was $80,000. So they're short about $11,000 just to even break even. They go on to say, clearly we need to bridge that gap of about $11,000 just to cover our expenses. And I'm exploring options to increase profitability. Specifically, I'm curious about the following. They go on to list a few questions. So Ash, I think maybe let's break it down. There's about 5 questions here. Let's read each question that they have and we can kind of pause and discuss. So question number 1 says 2-2 properties versus 3-2 properties. Are there significant advantages to offering a 2-2? For instance, does a 2-2 typically have longer average stays, or are they more desirable? So it sounds like they're saying like 2 bedrooms versus 3 bedrooms. They didn't tell us how many bedrooms their property was. I'm assuming maybe it's a 3-2 and they're thinking about maybe listing as a 2-2, but general question is like, do bedroom sizes and bedroom counts matter in the short-term rental industry?
Tony, I would think that it would be the opposite. I would feel like more bedrooms would be better.
Typically, yeah, in most markets. However, I will say, and this isn't true for every market, but I will say that sometimes you can see a market where the overall revenue in that city, like if you just look at all the, the aggregate Airbnbs in that market, revenue is down for the entire market. But as you start to split it out by bedroom count, sometimes you do see different trends at different bedroom counts. So for example, in a lot of markets, 5 bedrooms and 6+ bedrooms, even if the overall market is down, you might still see revenue gains with the bigger properties. In some markets, the inverse is true, where maybe there's a lot of saturation at the 4 and the 5 bedrooms, but just the people looking for a nice, 1 bedroom for a couple that's traveling, you're still seeing revenue growth there. So I think to answer this question, you would really want to dig into the data for your specific market and try and understand, if you just break it out by bedroom count, how are 3 bedrooms performing in comparison to 2 bedrooms? I do know someone, his name's Felipe, and he actually invests in Pittsburgh, but he has a big property. I think it's like a 5 bedroom or something like that, a really big property. But what he's found is that he can actually keep his calendar more full by listing it both as a 5 bedroom, and then he has a totally separate listing where I think he listed as like a 3 bedroom. And he has the ability to like lock off, I think either the top or the bottom or something like that, so he can list it both ways. And he found that by offering it in both configurations, he's actually able to generate more revenue. So if you've got a property, maybe you can do both, right? List it as a 3 bedroom, see what happens, and also list it as a 2 bedroom and see what happens there.
Okay, it's kind of a follow-up question for you, Tony, on this does the market depend on this? Like, is this market specific where like, if you're in Orlando where it's all families and stuff, is maybe more bedrooms better, but maybe you're in Joshua Tree where it's more, maybe couples going for, a weekend or something like that. How market dependent is this?
Extremely market dependent, exceptionally market dependent. And that's why I think really digging into the data for their specific city is going to give them the best answer, because we can talk about national data, but when you want to talk about tactical things to actually do to improve your performance, you always have to go based off of what is your specific market doing.
Okay, so their next question is the cleaning fee impact. So on average, we spend $2,500 per month on cleaning fees this year. Would encouraging longer stays realistically help reduce this, especially for a medium-sized cabin? So, Tony, is there any difference you see in this by increasing the minimum stay? Because I guess this depends on the listing too, but from my perspective, this is charged to the guests anyways, so it's not part of revenue. But I guess maybe if you're not charging the cleaning fee and you're just incorporating it into your nightly rate, that it doesn't matter?
Yeah, you read my mind on that one, actually. It's like most hosts in the United States right now charge a cleaning fee. And the reason we do that is because it is somewhat difficult to make sure that you're pricing your property appropriately to account for the cleaning fees if you try to just bake it into your average daily rate. So for me, and kind of what I encourage most people to do, is to charge your guests a cleaning fee. Now, make it fair and reasonable with other properties that are in your market, but at worst, you should be breaking even on your cleaning fee. So if your cleaner charges you $200 to clean your medium-sized cabin every single time, then you should be charging your guests at least $200 to clean that cabin every single time. And in some situations, you might be able to charge even more, right? If your cleaner is charging you $200, maybe you can charge the guests $225, and that extra $25 per turn can either go towards your reserves, it can go towards your operating expenses, it can help bridge that gap of that $11K that you're missing. But it sounds like you're maybe just eating that $2,500 cost, and I don't know if that's the best approach. The second thing that I'd add to that is don't be afraid to shop for new cleaners. If you do have a cleaner and you feel like their prices are above and beyond what's reasonable for that market, then go shop for another cleaner who can be more appropriately priced. We actually just had to let go of the very first cleaner that we ever hired. She was, the first Airbnb that we bought. She was our first cleaner. She taught us a lot about the industry and cleaning best practices and whatever it may be. But as our business evolved, she wasn't evolving with us. And we had to make the hard decision, last year to let her go and replace her with someone else. And while it was difficult, it was also the right business move. And we're in a better position now because we found a better long-term partner. So you always want to be evaluating those costs to see like, hey, does this still align? And are we getting the value that we're hoping for in paying this money out every month?
Yeah, we've had a similar circumstance where we ended up giving our cleaner a lot of jobs, like even some of the commercial buildings, cleaning the common areas, things like that. And it got more to the point that we felt like an inconvenience to her and I just got to the point where I was like, I want to be a customer. I want to, like somebody who's going to come and clean and is like thankful for the job and wants to give me a great experience as a customer and be happy about it. So like, I don't know if the person got like comfortable or complacent or what, but it's just like, it was kind of the same thing. Like we needed to grow and scale and
you got to find the right person. I think the only last point that I'd add to that, Ashley, is also make sure that whoever you've hired is someone who actually specializes in cleaning short-term rentals. Because someone who cleans an office building or someone who cleans, just someone's primary residence is going to have a slightly different standard than someone who's cleaning an Airbnb. Airbnb guests are ruthless when it comes to cleaning scores. And it takes a high degree of professionalism and perfectionism to satisfy the guest needs when it comes to cleaning. So just make sure that whoever you're hiring has the experience, has the expertise in that field specifically.
Maybe I'll take your feedback on this real quick, is that, so she does an amazing job. She cleans very well, but we have this one property that has 2 lofts. And we only list one loft in the listing, and we only have one ladder. But the ladder is transferable, where you can move the ladder and hook it onto the other loft. Well, we've had a couple of guests recently that have taken it to move the ladder, climb up in the other loft. They put a rave review because it's like a kid's loft and like all this stuff up there, whatever. And they love it. So we're like, okay, this is cool, like a little hidden experience, whatever. But our cleaner she said she's not cleaning it and said it's not in her scope of work, everything, which is true. It's not. And we just kind of took it as approach, like instead of just like being, I'm not doing it and being mad, instead of saying like, I'm going to charge another $25. Just want you to let you know they used the loft, blah, 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 and stuff like that. So it's a lot of like, we need someone with, that will take initiative and like, yes, we understand it's an additional fee, but to not, take it that way and to complain about it, I guess. But
and that was kind of what we ran into with the cleaner that we had to let go of as well. Is like there was just a disconnect in terms of like, hey, what are our expectations of the people that we're working with? And we want someone who's flexible. We want someone who can kind of take initiative. We want someone who feels like a partner to us with this portfolio. And, I think that cleaner, I think there were 6 cabins that we had that her cleaning for. So we weren't necessarily a small client either for, so yeah, I think a lot of it is like, hey, flexibility and initiative is kind of what we're looking for.
And also, Tony, that's on us too, is we should put that into our job description and be more open about that too when we are hiring people. So
yeah, but I think that's also why, like, for a lot of our properties, we build out these cleaning checklists. And there's some hosts who are like anti-checklist. They're like, hey, I'm not gonna babysit my cleaner. And we don't look at it that way. But when you build out a checklist, there's absolute clarity on what the cleaner should be doing at every single turn. It really alleviates any sort of misconceptions around what are your expectations as the owner and what are their responsibilities as the cleaner. So for us, we onboard a new property. One of the first things we do is build out that checklist so we know what needs to be done at every single turn for this property.
And what's the software you use again?
Yeah, Breezeway is the software that we use.
Well, enough about cleaning, but the cleaners are such an essential part of your reviews and your property's performance. So I think that was something we definitely needed to touch on there. Okay, and then the next question is year 2 turnaround. What strategies could we implement to project a higher ROI in our second year? So return on investment in our second year.
And this is true for any form of like, buy and hold real estate investing. So long-term, medium-term, short-term, whatever it may be. But sometimes when you got to, and this happens to us, right? I'll give you guys a real life example, right? The point I want to make is that sometimes you buy a property, doesn't meet your expectations, and you have to do the somewhat counterintuitive thing of reinvesting back into that property if you feel like the return might potentially be there. And this happened to us. Sarah, my wife, and I, we bought a house that we were expecting to flip. The market kind of shifted, the resale market shifted. We weren't going to be able to get what we wanted out of it. So we had this decision of either we cut a check and we sell the property, we don't hold it anymore, or we cut a check and we get to keep the property for our own portfolio. Either way, we're cutting a check. Like what makes the most sense? So we decided to keep the property. And because it was initially meant to be a flip, there were certain things that we wanted to add, right? That we didn't add because we were looking to get in and out of it quickly. But since we knew we were going to be holding it for a long term, we wanted to add some things. So the first kind of big investment that we made was adding an in-ground pool. And that was a big investment. It was like, I don't know, I think the pool cost like $100,000 to add this in-ground pool. And that is a hard pill to swallow after already having to write a check because it was a flip that went bad, to write another check to say, okay, well, let's try and make sure that we can really get the most out of it. But that property has done, incredibly well in comparison to some of our other properties that are in the same area that don't have the pool. So we know that we made the right decision by doing that. So kind of just going back to the point here, I think as you're thinking about improving performance, there's a few things you want to do. First, I would look at the other 3 bedrooms in your market that are performing well and try and identify what are the things, amenities, design, etc., that those properties have that yours doesn't. And you'll start to see some consistent themes, I'm sure, across those top properties. And then ask yourself, what is the potential revenue difference between where I'm at? You said 90, you said what were they at? 80,000, and where the other properties are at. And if you notice that by adding a pool, an EV charger, a hot tub, and a game room will get you from $80,000 to $150,000, and you see that consistently across multiple 3 bedrooms, well, now you've got a pretty solid case to maybe make that investment to get that additional revenue. But if you do that, your research, and maybe 80,000 is just as good as it's going to get for a 3 bedroom in your market. Like no one's doing more than 80,000. So it's hard to then justify investing any additional capital into that property if no one in that market has achieved the kind of revenue that you need to get to. So that's the approach. Do some competitive research and let your comps tell you what approach you should take.
So that kind of leads to their last question here, the exit strategy considerations. If that's not working or they don't want to invest the money to add those amenities, is it actually worth absorbing some of the costs by them losing $11,000 a month or $11,000 a year and focusing on long-term appreciation?
I feel like it varies investor to investor, right? It's like, what was your goal when you bought this? Like, Ashton, I know you've talked about like you've bought properties kind of specifically for the appreciation play before, right?
Yeah, I've definitely never lost, a little under $1,000 a month. So for me, I probably wouldn't do that deal if I was having to put in, $900 or so every single month towards a property. But there is one property that we break even on, and it is in a area that is seeing appreciation, gentrification, and our plan is to sell it in the next 3-4 years, and we're cash flow even, we're break even on it. So. But I would, if I saw potential in a property, I would lose some money, probably not that much on a property, but I would lose some. But I'll take it another way. Like there's a duplex that I haven't rented in the last 3 months because of the previous tenant that was in there. And I'm waiting till like the dust settles and everything is done with them because we're still going to court, even though they don't live in the property. And so like I am willing to not take that money right now and rent it out until this like settles, just for like ease of mind, or like that something else could potentially happen. So I will take losses in other ways, definitely in the business. But I would say for this circumstance, I would try to increase the revenue, but also you have to look at what your appreciation is. Like if you're going to be making a lot more than what you're going to lose over the years, then maybe that is a good investment for you too.
Yeah. And I think it's hard without knowing the exact market and being able to kind of look at the data. But what we've seen and again, I mentioned this earlier, but what we've seen in a lot of the super popular Airbnb destinations is that supply increased dramatically. There are a lot of people fighting to get into those markets. The increase in like buyer demand drove up prices. The increase in people buying drove up supply in those markets, and that increase in short-term rental supply then starts to pull down on the revenues in that market. And then as the revenues start to get pulled down, you get some investors to start freaking out. They start trying to offload some of these properties. So there's this weird thing where in some of these markets, you've seen prices go up. Now they're starting to come back down, but because rates are so high and this, that, and the other, that revenues and purchase prices have started to fall. So I think looking at your position, I think just asking yourself, well, are you still seeing appreciation in this market, right? Is the revenue a sign of the revenues in that market coming down, or maybe you're just not managing the property correctly? Or is that $80,000 in revenue a sign of the market being pulled down? And if that's the case, you got to ask yourself, okay, well, what does that mean for appreciation? Now, most deals that you buy, you look up 20 years from now, it's probably going to be a good deal. I think the question is, does it make sense for you to hold on that long? Or could you potentially redeploy that capital elsewhere where things are maybe moving on the upswing and not on the kind of flatter or the downswing?
Yeah. So like you could do a 1031 exchange and move into a different property that maybe was cash flowing. But also like along with taking that loss, do you have any tax advantages to this property that maybe you're actually saving more money in taxes, that if you did sell the property, you wouldn't have those tax benefits anyways, and you'd be paying more than $11,000 a year in taxes. So at least that $11,000 is going towards your mortgage pay down, hopefully, and your property. So, and not to taxes. So that's another benefit to try to look at too, as to what's the actual tax advantage you're getting every year from the property, and is it worth it to have that loss?
I think the only other thing that I'd add to this point, actually, just to kind of clarify what I said earlier, I said we spent $100,000 on a pool. I'm not saying that the only way that you can improve your revenue is by spending six figures on like an in-ground pool. It's not what I'm saying. What I'm saying is there are probably some amenities in your market. Some could be big, like an in-ground pool. Some could potentially be smaller, maybe painting a mural, right? And just sprucing up your outdoor space.
An Instagrammable background.
Instagrammable moment, right? Maybe it's something as small as, making sure your review scores are solid. We didn't talk about how well the listing's actually doing, but if you've got like a 4.5 star rating on Airbnb, well, fix that, right? 'Cause that's super low hanging fruit that you can go after. So the goal is to do the research and just see in general amenities, experience, design wise, what are the top performing listings offering, and how much of that can you implement back into your own Airbnb?
Well, thank you guys so much for joining us for this Rookie Reply. I have one special announcement. It is time for BPCon 2025 to start thinking about it, because pre-sale is happening on February 3rd and you can get discounted tickets. So make sure you go to biggerpockets.com/conference and you can find out all the information. Tony, where is BPCon this year?
BPCon is in Sin City. It's in Las Vegas.
Yes, it is in fabulous Las Vegas. And little fun fact, the first time I ever went to a Las Vegas pool party, that was with Tony and his wife, Sarah. So maybe Tony will host another one again, but you won't know unless you're there. So biggerpockets.com/conference. Thanks, you guys, for listening to this episode of Rookie Reply. I'm Ashley and he's Tony, and we'll see you guys on the next episode.